Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of Netflix Inc., ticker symbol NFLX. It's safe to say that Netflix's stock has had a disappointing 2022 so far. They've had two huge drops on their quarterly earnings, both in the first and second quarter, and over the past year, they're down 64%. Year to date, they're actually down 70%. So Netflix has definitely taken a beating. What's absolutely amazing about their stock is that even being down 70% from their high, Netflix has still returned a 34% compounded annual return over the past 10 years. So if you had invested in Netflix 10 years ago, you would have been absolutely crushing the market and outperforming virtually every other business out there. Instead of being interested in just their stock price, through our fundamental analysis, we're going to dig down into Netflix's financials and come to a beginning understanding of how to think about the business and what it may be potentially worth, irregardless of its stock price. That being said, at the time of recording this video, Netflix is trading for about $185 per share. Like we mentioned, they're significantly down from their 52-week high. They peaked at $700 and they're all the way down to $185. On the back of their subscriber loss, this has been an absolutely brutal downturn for Netflix. Even with that 70% decline, Netflix still has a market cap of nearly $79 billion. So it's still a very large business. For more background about the company, Netflix Inc. provides entertainment services. It offers TV series, documentaries, feature films, and mobile games across various genres and languages. Its streaming platform provides video on-demand service, now available in almost every country worldwide except China. Netflix delivers original and third-party digital video content to PCs, internet-connected TVs, and consumer electronic devices, including tablets, video game consoles, Apple TV, Roku, and Chromecast. In 2011, Netflix introduced DVD-only plans and separated the combined streaming and DVD plans, making it necessary for subscribers who want both to have separate plans. Netflix has approximately 222 million paid members in 190 countries. Netflix was founded by Reed Hastings in 1997 and is headquartered in Los Gatos, California. So with that background, let's get right into our fundamental analysis. We'll be performing an 8-pillar analysis as popularized by Everything Money to look at Netflix's financials and come to a beginning understanding of the business. Starting off with pillar number 1, we want Netflix's average 5-year PE to be below 22.5. Currently, they're trading 16 times earnings, so right now, Netflix's price is by far the lowest it's been relative to its 5-year history. And their current price is actually the first time that Netflix, on a PE measure, which doesn't really tell you anything about the business, only tells you about its valuation, is trading below the S&P 500's PE. So that's just one thing to keep in mind. However, we're looking at the average through this pillar, not just its current PE. So pillar number 1 is still going to be an X. Next up, pillar number 2, we want Netflix's average 5-year return on capital to be above 9%. So Netflix does a good job here. They've steadily increased their return on capital over each of the past 5 years, and they average about a 12.6% return on capital. So that's our first check on pillar number 2. Pillar number 3, we want to see 5-year revenue growth, and Netflix has almost tripled revenues from $11.5 billion in 2017 to nearly $30 billion in 2021. Scrolling down on their balance sheet, pillar number 4, we're looking for 5-year net income growth. Net income, this column in white here, has more than 10x'd since 2017. So that's a huge check on pillar number 4. 3 checks in a row now from pillars 2, 3, and 4. So far, we've got 3 out of 4 checks on Netflix. Next up, pillar number 5, we want Netflix to be decreasing their shares outstanding. We don't want a business to be diluting existing shareholders and ultimately giving you less ownership percentage of that business. So with a high-flying business like Netflix, it's not surprising that we see some share dilution here. However, it's only been slight. In 2017, they had 447 million shares outstanding, and that's increased to 455 million at the end of 2021. So this is going to be an X on pillar number 5. Next up, for pillar number 6, we want to see 5-year free cash flow growth. So free cash flow is cash from operations minus capital expenditures. It's this column in green here. And even though they had a loss of $2 billion in 2017, they've actually shrank that loss to just losing $100 million in 2021. So this is technically going to be a check, even though they didn't have positive free cash flow last year. So one thing I want to point out about Netflix is this amortization of deferred charges. So because Netflix is a digital business, they're dealing with copyrights, digital assets, and not tangible assets. Netflix is able to amortize these intangible assets over time, similar to how physical assets are depreciated over their working lives. So this might sound like technical accounting mumbo jumbo, but the big thing to note here is that Netflix has a pretty long leash in how they're amortizing these charges. From an accounting and business standpoint, what these charges really mean are that Netflix is trying to get as much of the upfront tax benefit from amortizing these charges as possible. Netflix has this incentive from an accounting standpoint to report the majority of their content spend as being necessary to maintain their current subscriber base, even though they've really ramped up this spend in recent years. And it looks like some of that increased spend is at least attributable to growth. Netflix's accountants said that that spend was related to growth and not related to maintenance. They wouldn't be able to get the tax benefits from amortizing these charges. So that's a more nuanced aspect of Netflix's free cash flow accounting, and something you want to make note of and do more research on to better understand the business. So moving on to pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and equivalents, to be below their average 5-year free cash flow multiplied by 5. So Netflix had a negative average free cash flow. They're burning about $1 billion a year, and currently they have $12 billion of net debt. So based on that, pillar number 7 is going to be an X. However, keep in mind those amortization charges, and so pillar number 7 might not be as bad as first meets the eye. Finally, the big pillar of them all, pillar number 8, we want Netflix's market cap to be below their average 5-year free cash flow multiplied by 20. This pillar gives us a starting point of how to think of the valuation of the business from a free cash flow perspective. So currently, Netflix's market cap is just under $79 billion per share. And as we found out, they're burning about $1 billion of free cash flow each year. So pillar number 8 is also going to be an X. So in summary, Netflix checks the box on 4 out of 8 pillars. They've been growing like crazy, and they actually look like they're trading for a reasonable earnings multiple now. However, their free cash flow leaves a lot to be desired, and because of the nature of their business and some of their accounting incentives, we're not seeing the true nature of their free cash flow profile, which makes it very difficult when we're trying to assess the business's leverage position, as well as how the business trades in comparison to its ability to produce future cash flows. So undoubtedly, if you're interested in Netflix, this is a company that you want to do more research on. I highly recommend getting down into the nitty-gritty, going through the weeds of diving into one of their 10Ks to really understand their financial results in more depth and understand how they're being accounted for. That's it for today's stock analysis of Netflix Inc., ticker symbol NFLX. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Netflix was a subscriber request, so thanks for learning about Netflix, and have a great day.